Interest rates are on the rise. Over the course of the past month, interest rates have been floating near 7%, of course varying between conventional FHA, VA, and FICO scores. However, just today, interest rates saw a recent spike. Let's dig into why. Jobless claims, as we've mentioned the past few weeks, is the most important data factor we're watching weekly. Jobless claims were at nearly a 2-year high. And we had back-to-back consecutive weeks of increasing jobless claims. Unfortunately, today, jobless claims came in at 239,000 when it was expected, and last week was at 265,000, showing that people did find jobs and there wasn't as many jobless claims. In addition, Q1 GDP was estimated at 1.4%. However, today it came in at 2%. Both of these are signaling for a stronger economy, and when we have a stronger economy, this gives the Fed ammunition to continue to hike interest rates. Just yesterday, Jerome Powell continued to say that we may see interest rate hikes in the near future. After today's jobless claims report and GDP, the CME futures is basically predicting an 88% likelihood of an interest rate increase on July 26th. And of course, this is the federal funds interest rate, which is currently at 5.25% and will likely be raised to 5.5. So again, interest rates are going up, but could this actually be a good thing? In the short term, it doesn't feel like it. However, we know that interest rates increasing does lead to more inventory. There's a conflicting theory that people think the interest rate lockdown theory is causing people to not sell their house. Ultimately, that is true. However, this does not actually lead to more inventory, because if you are selling your house, or if you're afraid to sell your house now, but if interest rates dropped and then you did sell your house, well, you would still be a net buyer of a new home, which ultimately does not increase inventory. We know there are 2 ways to actually increase inventory that have been proven statistically over time. First and foremost, foreclosures, right? Which is why job loss is the most important data point we continue to watch weekly. Because if there's job loss, this leads to more foreclosures, it leads to distress sales, it increases our inventory. That is not coming, as foreclosures are exceptionally low at this moment, and if they did rise, would take over a year. The second is basically higher interest rates. And we saw that in the back half of Q3 and Q4. We saw interest rates go from 2.99 all the way up to 5.99, 6.99. And what did we see? We saw inventory more than doubled. Well, at the end of Q4 and in Q1 and Q2 of this year, demand has completely stabilized. That shock of interest rates is gone. People are still buying at the 6.5%, 7% range. So again, it's a case that higher interest rates could theoretically solve our inventory problem. And I'm not saying they're going to go dramatically higher. I don't think they can go dramatically higher, as we're seeing many people stretched in regards to qualifying. The absolute, multiple people on home loans need to be used right now to qualify. So stretching is already a difficult problem. So by interest rates going from maybe 7 to 7.5 or 8, it's going to be even more difficult to qualify. However, this could be what the Fed wants, because if it lessens the demand, what does that do? That increases the amount of days on market, and that is how inventory increases, because a seller lists their house, because some people will always have to sell, right? There's going to be that interest rate lockdown. That is true. It doesn't solve inventory, but there's still going to be people who need to sell no matter what. So when they sell, less demand equals that their house sits on the market longer. Sits on the market longer, days on market, it adds up the existing inventory going up each and every single month. So again, that's the case that higher interest rates theoretically could solve our inventory problem. It would still take 3, 6, 12 more months. Again, I'm not in the camp that they're going to go much higher, but in reality, you have to look at the positives with the negatives. Interest rates going up, we don't want to see it. No one wants to see it. They're already higher than we've seen in the past 15 years, so we don't want to see it go up. However, if they do go up, let's try and look at the bright side. Let's try and look for some reasoning as to how this can actually help us as individuals, and how it can help us, or how it can help the overall status of the housing market. let's stay tuned. Let's continue to watch the data each and every week. We don't have a lot of huge news weeks coming up. Next week is July 4th. We have jobless claims, of course, every single Thursday. The next Fed meeting is not for 4 weeks, and the next CPI report is not for 2 weeks. So we could see maybe a stall in interest rates for a little bit. But again, let's continue to watch that jobless claims report. That is the driving factor right now of interest rates.